Well, Mike, thanks for joining us. Mike, the cost-to-income ratio in the latest period was down from 47.3 to 44.4. How much further can that go?
It will continue to drop. You know, I think we're about 5 years through changing our whole operating model and basically moving our operations and technology to offshore hubs. As I say, we're about 5 years through that process, and we're now beginning to see the benefits of that coming through on the cost-income ratio. And I think we have another 5 years to really finesse it and really make it work for us.
Do you have a target for the cost-to-income ratio at the end of that 5 years?
No, I don't. I've got one until the end of next year, which was a 2% drop from the end of last year. And as you've seen, we're about 70% of the way through that. So when I get there, we'll create another target.
Is there some kind of natural limit to how low costs can go?
Yes, there is. I mean, I think, and each bank is different because it does depend very much on the mix of business. You know, a retail bank traditionally with a big branch network would have quite, relatively high cost-income ratio. A merchant bank in the old days, the old investment bank style bank, which had very, very high salary costs, would have a higher cost-income ratio than a retail bank. But technology is changing things. There is no doubt that the cost of operating is reducing courtesy of technology.
Mike, so you're saying this is not just about offshoring and cheaper labour, this is actually about real change and productivity gains?
Oh, absolutely, and it's about technology. You know, it's about, if you think about the average channel by which people touch the bank now, most of it is done on the internet or through mobile phones. It is not done through the branch network. So this enables you to take out quite a significant amount of cost.
Would this been happening anyway, or has the expansion of ANZ into Asia created a base and a platform for you to do these sort of things?
Well, I think the expansion into Asia has been made possible by the fact that we can support the business in Asia through these hubs. So it is very much an integrated part of the strategy, and therefore this has worked for us probably much more easily because it's easier to see than if you were a purely domestic play.
Are the other banks in the same situation? Will they reduce their costs by a similar amount?
Well, they're going to have to look at their operating models. I mean, and quite clearly they are doing that. You know, we're seeing all three of the banks working on productivity and efficiency. And indeed, you know, you have to do that. In fact, other industries have to do it as well. You know, we were used pre-crisis to a high growth environment. Your top line was every year grew significantly. That meant that you could have a cost model that anticipated that. Now you've got a lower cost environment, so therefore your costs have got to be far more finessed. Also, of course, when you have high top line growth, it does hide a multitude of sins, and you certainly aren't as efficient or as productive as you need to be.
In Asia, you get a much lesser return on your income than you do in Australia, and yet you intend to expand in Asia.
Yeah.
Does this mean that down the track your actual returns on income will fall as Asia gets bigger?
No, because whilst you're in an investment phase in any place, your returns are bound to be lower. The issue is that you are basically building in future growth in terms of not only volume but return. So I'd rather have a low return business that has the ability to grow than a high return business that can't grow.
Have you had to slow down your ambitions in Asia, the pace of your expansion in Asia, and is that why you increased the dividend, to distract everybody from that?
No, not at all. You know, basically our whole Asian strategy is based, or you know, the super regional strategy is based on organic growth, and that organic growth we push as hard as we can. Obviously, if there were acquisitions around, if there were suitable targets, of course we would be very happy to look at those. Right now, there's just very little around, so the organic growth is the best option. But we continue to grow. I mean, we were growing at about, you know, between 20 and 30% across most businesses for the year, so that's not bad growth.
Mike, one of the things that came out of the commentary within your interim result was that within Asia there's been a shift in emphasis from traditional lending to other products and services. Is that a response to competition or perceived risks? It's
a bit of both, but I think that the key rationale here is use of capital. You know, banks have got to get much better at using capital than they have been previously. I mean, prior to the crisis, banks were generating 20% ROEs without really having to do much, because it was being driven by volume growth, you know, by that top line growth. And you've got to remember that since 2007, we're actually holding about 60% more capital on a like-for-like basis than we were at that time. Therefore, you've got to make your capital far more efficient, and you've got to manage it far more efficiently. Therefore, products and particular debt capital market, for example, the debt capital market side is obviously much more important to us now than it was pre-crisis. And the loans, which eat up capital, have got to become less important.
Do you have to have that much capital? Can you, I mean, could you get it back and still be above the requirement?
Well, you know, that's what we have to do. We have to be much more disciplined on using capital, and I think you've got to be able to flex it a little bit. You know, what we have done is tended to build it up in anticipation of needing it for regulatory reasons, and I think we've got to, you know, we've got to manage that much more tightly, be more disciplined around it. Quite clearly, the regulatory regime has not yet finished. In terms of imposing additional capital requirements on banks. But I'd like to see some degree of stability as we go forward. I think, you know, there has been so much change, and whilst Basel III was laudable for trying to create a global level playing field, quite clearly that hasn't happened. And now the fragmentation is probably worse as we've ever seen it, which basically means that national interests have taken over. And I think we have to be very careful that we don't get too far ahead of the game.
Do you think, just widening the discussion, do you think that it's unhealthy for a stock market like Australia to have more than 30% of its capitalisation in the top 4 banks, and just over half the top 10 companies are the 4 banks? That's a huge concentration in one industry and 4 companies. I don't think anywhere else in the world of comparable size that that's taken place. Do you think it's healthy?
Well, I mean, it's where we are, isn't it? It's we are where we are. The fact is that in Australia, 4 of the 5 largest companies are banks, and have been for many years. Look, I mean, I think any deepening of the market, any improvement to increase the number of larger companies in Australia would be a healthy development. Certainly, you know, we should be encouraging inward investment into Australia.
Why do you think it is that this country has ended up with such a huge proportion of banking in its capital and business structure? No other country's done that. Is it the nature of our banks? Is it the nature of the actual society where it funnels things to banks? Well, why do you think this has happened to us?
Well, it's an interesting question, not one I must admit I've given much thought to. I mean, I think that traditionally the this country was based very much on the large miners. You know, that was the big end of town. I think that the agri side has probably been purchased by overseas interests, and I suppose some of the mining interests have as well. But the banks have stayed national champions, if you like. I guess the issue for me, in terms of what banks are here to do, is that how do we have an Australian bank? How do we create an Australian bank which can actually support the Australian interests on a regional basis? Because quite clearly, if you look at the terms of trade and look at the investment flows between Australia and the region, that has to be oiled. It lubricated, if you like, and that requires banking expertise. And at the moment, far too much of that flow is driven by either global banks or banks up in the region, not by Australian banks. And I think for us to move into the region is a critical development for the benefit of Australia.
Just on another subject, Mike, if I can ask you, last year we heard about the fixing of LIBOR, or the allegations that LIBOR was fixed. A lot of stuff going on at the time, and presumably that's still a matter for regulators to investigate. Just the other day there was another story that interest rate swap market is also being fixed. Do you know anything about that? Have you been aware of any price fixing in the interest rate swap market? And obviously, have you been involved in any? And if so, if there has been, how would you feel about it?
Well, I'm not really sure what they're referring to here, because if it's BBSW, I mean that's basic.
No, this is global, not the Australian BBSW.
Okay. Well, the important thing is that any market which is driven by actual transaction and not just quote is always going to be much more resilient and hold up to scrutiny much better, which of course is what we've got here in Australia. In terms of the global swap markets, I haven't been aware that there had been any major issues. Pricing for a swap is basically generated by the two counterparties involved, and that should be basically to both advantages. So it's hard to see where there would be a problem.
Mike, a little earlier you referred to the fragmentation of the regulatory discussion occurring around the globe. Yeah. I'm sure you're very aware that in the US and in Europe, but particularly the US, there's been a lot of discussion amongst regulators and politicians about simple leverage ratios and 15% to 20% equity against unweighted assets. Given that our banks are full of lowly risk-weighted mortgages, if that would become some sort of global standard by de facto, what would that do to us? Well,
it would have an impact, there's no doubt, on Australian banks. In fact, ironically, it would have less impact on ANZ than it would on the others, because, of course, our mortgage book is that much smaller. But the talk of leverage and leverage caps has been around for a long, long time. As I say, the first move was to actually create a proper Tier 1 capital ratio. The argument seems to have stopped there. Then you had the issue with global SIFIs, significant institutions. Then there's been the argument about domestic significant institutions and whether or not they should have higher capital. The Canadians have just introduced such a rule where they put a 1% additional capital requirement on their domestically important institutions. So, there are all sorts of things out there, and they have been out there now for some time, to say nothing about the liquidity requirements, which of course, continue to bubble away as well. But I think that the reality of the situation is that the banks, particularly the banks in Europe, just are not able to meet many of these requirements. They just, they just cannot possibly conform. So until such time as I think some of this gets worked through, I think we've got to be careful. We don't, as I said before, that we don't get ahead of ourselves, that we don't become effectively uncompetitive by being too boilerplated, if you like.
Mike, in the theoretical situation of the Reserve Bank lowering interest rates by 0.5% during as this year progresses, do you think that would stimulate the economy, or do you think that the interest rate stimulation has just about run its course?
Look, I mean, this is a personal view. I don't see the information that the Governor of the Reserve Bank does, and that's not a job which is an easy one. For me, I think interest rates at the moment are, at effectively an all-time low in Australia, well, particularly in recent memory, in the last 20, 30 years. Is it going to make a big difference to drop interest rates another 0.5%? I don't think so. I think the issue right now is business confidence. If business confidence returns, and business confidence returns because of government stability, government consistency, government policy which is consistent, you will find, I think, a bounce in the economy. So I think business confidence is critical, because that creates consumer confidence.
Do you think if Tony Abbott wins and he's able to restore confidence, you'll see a bounce in the economy?
Yeah, I think, whoever wins, I think the important thing with the election is that whoever gets in next, they have a clear mandate to govern. I think minority governments, I think we've had that experiment. It's time to move on.
One more thing on interest rates. Do you think that if deposit rates are lowered further as official rates come down, or if they do come down, it will switch even more money into bank shares away from deposits, and perhaps make Australian banks much more dependent than they have been on wholesale markets overseas?
I think there is an element of risk in that. There's no doubt that as sentiment has improved and investor confidence has returned a little bit, people are beginning to look for yield. That has been exacerbated by the sheer amount of liquidity in the system. I was pretty concerned about the bond markets and as to where they were going. It seemed to me they were overpriced, and that was the next problem waiting to happen. But then the Japanese government opened the tap with their own easing policy, and of course, bonds have rallied enormously. So who knows what will happen? I mean, I think that that search for yield, whilst there is so much liquidity, is going to continue. And I guess the big problem is that there is probably not enough high-quality assets out there which are providing good yield.
Well, I mean, how do you feel now? Actually, you're supposed to know how it's going to end, not ask us. How do you think it's going to end? I mean, with all the quantitative easing, do you think the Fed and the Bank of Japan are going to be able to exit smoothly or not?
Look, I think that the US probably will be able to manage its easing. To finish its easing in a relatively benign way. I think the issue is more what is the impact on other countries. I think the US itself is probably okay, but some of the developing countries may well struggle. I think that for Japan, their record in terms of economic management over the last few years has probably not been the best. this is certainly the most significant thing that they have done in many years. Let's see what happens there, but it can't go on. You know, there has to be a finite, or there has to be somebody has to draw a line in the sand at some stage, and hopefully the economies are on the move by that time. If they're not, you know, you're running out of options. So I tend to think that the US will be the first to recover and certainly will start to move. You know, there are still obviously political issues in the US and it's hard to get anything done or agreed, but definitely the economy is moving the right way. And I think that you look at the long end of the curve in US dollars right now, you're already seeing a kick up in rates. So the anticipation that interest rates will go up in the States is there. You know, the market's beginning to price it in. So I think that's a good sign.
Hey Mike, were you offered the job of running Barclays Bank last year?
Well, you know, you get approached for all sorts of things. You know, would I want to go back to the UK in that political environment to run a bank? I don't think so.
Sounds like you were offered. Sounds like you were offered the job, though, were you?
Yeah, look, you know, I get all sorts of things across my desk. You'd be amazed.
Mike, you've had vastly more experience at the coalface in Asia than any other senior Australian banker. Where do you think the China's economy is right now? And do you think they can actually manage to transition from that sort of export-oriented model to a consumption-oriented model?
Look, I think they can. They do think this stuff through very, very carefully. I think that the size of and scale of that transition is staggering. And I think that the issue that has to really be managed well is the social change, the social adjustment that will go on in the country. I believe that the new leadership is a very different breed from the last leadership. That was very much technocrat. And bureaucrat driven. The new leadership is much more has got a much more common feel with the people as well, and I think that is probably a very good way to make that transition start to happen, as well as being incredibly competent administrators. So. Look, from what I'm seeing in China, it's you know it will have its ups and downs and whatever, but the trend is still pretty positive, and I would expect that the growth to be over 7%, probably nearer 8% for this year for 2013, and I suspect that will be maintained fairly consistently in the next few years.
Thanks for joining us, Mike.
Thanks, Mike.
Great to talk to you. All the best.